It is too late. Hey, everybody. Listen, welcome to this episode of Derek Invests. We are going to do the market mentality today, and we're going to switch it up a little bit. I want to talk about residential real estate. We talk about real estate a lot on this show, and we've been talking a lot about residential real estate. And one thing that I like to do when I'm looking at numbers and I'm looking at different reports is I like to know what's going on in the street, what's actually happening out there. What are the professionals seeing going on in this market? So I brought a friend of mine, a good friend of mine of nearly 20 years at this point. His name is Matt Pivetti. He's a San Diego real estate professional, and he works for Real Brokers. He's part of the Real Brokers group. He has been in residential and commercial real estate for as long as I've known him. So I think it'd be great to touch base with him. If any of you are interested in just having a look at Matt, who Matt is, let me get a QR code up for you. And Matt, let's see. Why don't you introduce yourself? Add anything that you'd like to that introduction, and we'll get going.
Hey, Derek, thanks for having me on. Appreciate it. I don't know. I think you did a pretty good job there with the intro. That's who I am. Real estate broker here in San Diego County. Been doing this for over 20 years at this point. Doesn't seem like that long, but sometimes it seems like it's been longer. But
listen, it's one of those things for me as well. It's like it happened in a blink and it took an eternity.
Yeah, exactly.
It's right. It happened in a blink and it took an eternity.
Yeah, somebody, a friend of mine said that recently with regard to kids, and he said the days are long and the years are quick.
I love that.
Yeah, it's poignant, and I think it ties back into what we're just talking about as far as being in this business and kind of going through so many different cycles that all seem to be the same, but come and go quickly. But when you're in the middle of them, it seems like forever.
Well, Matt, that's a great segue, if you don't mind. I think you introduced something that I really would like to talk with you about. I've talked a lot about what I see as far as numbers go, what I see on charts, and what I'm told by government agencies that are within real estate. And what I like to do, Matt, and what I do all the time in the show, I know you know, is I look at history. So you mentioned cycles. That's an interesting point. So could you, look, we've known each other. We went through the 08-09 cycle together, right? Could you walk us through maybe what some of those cycles were like as compared to maybe the cycle that we're in now with residential real estate and what you think the differences or similarities are?
Sure. Obviously, back at that time from let's say 2003 through 2006, it was kind of this upward swing, right? Everybody thought, oh, everything's great. Things were selling quickly. Everything was selling for more than list price. You couldn't keep things on the market, right?
Right.
There was a ton of buyers out there. And then all of a sudden, boom, right? The bottom fell out. And there were some factors that added to that, right? A lot of deregulation with the banking industry, and when that took place is probably in the late 90s. A lot of that deregulation was occurring, and then the result was sort of witnessed in that early part of the 2000s. And when I say deregulation, what I'm talking about specifically with real estate is the introduction of all of these loans that made it significantly easier for people to buy homes, right? No money down, stated income, interest only.
And Matt, that started in the late 90s?
I think a lot of the deregulation took place at that point. Okay. And then I think as you got into the early 2000s is when banks started introducing those products into the market.
Okay.
And then so you saw a lot of people taking advantage of that. And whether it was, hey, we really want to get into the market. Things are going up, 15% at least every year, if not quicker than that. So we'll buy something, we'll put no money into it. In a year from now, we'll sell it and we'll cash out and we'll make 30 grand or 50 grand or whatever it was. We'll put no money into it. We don't even have to really qualify for this loan because they're just giving them away. As long as you can fog a mirror, you're good to go. And what happened was a lot of those loans, because interest rates were actually almost about where they are right now, actually, in the mid 6% range.
Wait, Matt, just to clarify, when were they in that range? When were they just about where they are now? What year was that?
From like 2003 through 2006. So when all these people were buying and it was crazy, that's what the rates were. They were 6%, no problem. And that wasn't even for a fixed 30-year fixed loan. That was, a 2-year adjustable, 3-year adjustable, 5-year adjustable rates. Interest only payments, which help people qualify for having to produce less income. But then you also had stated income loans. So, they just said, hey, I make 10 grand a month and I do janitorial services at the local school. And the banks were like, okay, cool. Obviously we know that wasn't accurate, but what happened was you started seeing by 2006, a lot of these people that bought in 2004 and they purchased with a 2-year adjustable loan, and a lot of them had prepayment penalties and they didn't put any money down. And they hadn't really gained any equity at that point. And then their mortgages were coming due for an adjustment, right? And so their 6% mortgage turned into a 6.5% mortgage. And a lot of the interest only periods were ending. So all of a sudden you went from an interest only payment to a fully amortized payment. So instead of paying $2,000 a month, their payments were jumping to like $3,000 a month. And a lot of the people were like, oh, well, we can't stomach this. This is not where we're at. Then all of a sudden, okay, well, we got to get out of here so we don't go delinquent. Let's put our home on the market. And that kind of flooded the market. Then, simple supply and demand, it caused prices to kind of drop. And you had a situation where nobody had any equity. So now all of a sudden loans were upside down and you're starting to see short sales, foreclosures, et cetera, which kind of pushed us head first into that whole 2008 through 2012 period of the cycle where it was just doom and gloom. Everything was just fire sales, tons of stuff on the market. They built a lot during that period of time too. So there was a lot of inventory out there, and then you just had nobody able to buy, because then all of the banks started shutting down those programs. So nobody could even qualify for anything anymore. Rates were still relatively high. We say high now because we've experienced what they were back in 2000, around the 2020, where they were 2.5%, 3%.
So Matt, let me ask you, so it seems there was a clear-cut difference. Maybe I saw a couple of similarities. Correct me if I'm wrong. One thing that was really similar, and we're talking about it now, is how high interest rates were. It sounds like they were really equivalent to now.
Sure.
It sounds like regulations were slightly easier, I guess, for loans back then. I mean, they were taking a lot of stated income. Correct me if I'm wrong, but there's a lot of like no down payment going on right now, no? Or it's possible? Is that the case?
You can get low down payment loans. Like FHA has a program. The Federal Housing Administration has a 3.5% minimum down payment.
Okay.
You've got mortgage insurance built into it, so they're kind of hedging on that aspect. VA provides the no money down loan. But as far as conventional financing, typically you're having to put down 20% these days. And that's kind of the key difference between what is taking place now versus what took place then, is that people that have bought over the last 15 years have qualified for their mortgages based on actual documented income. They put money down, so they have skin in the game. And then we've seen this record appreciation. So now a lot of people have a ton of equity in their homes.
Right. So
as far as the difference between that period and this period, if we're talking about, okay, maybe we're seeing a slowdown in the market, what is that? How does that forecast out? Is it going to be the same thing? And I don't believe it will be, just because of the simple fact that so many people have a ton of equity already in their houses. Like, I don't know the exact number, and I could look it up, or somebody could look it up, but I think people are in the 50 to 60% equity range.
Okay. So let's just backpedal just a little bit. You had mentioned that, those low rates that we had going into, I mean, it was through 2020. that we had these, like crazy low rates, right?
Yeah.
So, I mean, would you say that those low rates probably helped to drive real estate prices higher through that time frame? Is the fact that, because you mentioned the cost of your mortgage, right? Your monthly, which I think is what most people look at, and you said, hey, listen, from 2003 through 2000, let's just call it 2007, rates are where they were, but then you had stated income, you had no money down, and you were doing interest only, which really interest only, the only reason to do interest only, and people tell stories about how that they're a professional at this and they know this is going to happen and that's going to happen. But the fact is, you're trying to save cash flow. You don't want to pay principal. You want to, so you're able to have these low down payments. So you had those low down payments, which kept your monthly payment low. And then we came into the cycle of maybe 2012 through 2020, where just like the low rates kept your monthly payment low. And now we're at a place where we have those inflated prices. So we've had a run up, and we had a massive inflationary push in 2021. I talk a lot about it on this show when the U.S. pushed 50% more currency into the market in 1 year, right? It generated that inflation. So let me ask you, Matt, as far as, let's talk affordability, but from a human scale, right? Not numbers, not that sort of thing. From a human scale, you lived through, we'll call it 2008, 2012 cycle. And now we're in this cycle. We could call it 2020 to 2024, because that's where we're at. We don't know when the cycle ends, but what do you think about the affordability issue right now? Is there an issue? Is there not an issue? What are you seeing out there? So if you find someone and they're madly in love with a house, what's the next step? Where's the barrier right now, I guess, in the real estate market? Because you laid out a lot of good points about the things that are good right now, right? So what are some of the barriers? Why are we having this slowdown?
I think it's rates. I think it's price, right? So you got prices that are higher than they were, and you've got rates which are higher than they were. That on twofold causes your monthly payment to increase, right? Because you're paying a higher price and you're paying a higher rate. So your payments are up. I think that has caused some buyer hesitation for sure. The thing that's a little bit different that's keeping the market, whether it's flat or, a slight downturn, it's not much, couple percentage points, if that at all. Longer days on the market, although the data would tell you not much. I think that sorry, I lost my train of thought here. But I think that what you're seeing that's keeping the market where it is the lack of supply. You still have a super low supply. I mean, it's only 2.5 months worth of inventory here in my market in San Diego. And so that's still a seller's market. So you're still seeing some hesitancy on behalf of buyers, but I think that ultimately when they find that place that, hey, I think that this is our home for the next 10, 15 years plus, they're pulling the trigger on it still. So in highly desirable areas, it's not really changed. People still want what they want. And, San Diego and Southern California is a little bit of I don't want to call it a bubble as far as like a bubble that can pop. It's a bubble in that people want to be here, right? You've lived here, so you know what it's like, as far as weather, as far as, people, as far as lifestyle, all those things. It's highly desirable. But not only that, you have this factor where, kind of what we're talking about as far as interest rates about 4 years ago, and all those people that had bought, in the last, like, say 12 years, 0 to 12 years ago, they're locked in at those super low rates. And so there's a lack of desire on behalf of those people to trade what they have for something else, right? Because now let's say you bought your house, and I'll use the prices that I'm used to because that's what I'm familiar with.
Please do.
Not a national thing. So, but let's say you bought your house 8 years ago for $1 million, and now it's worth $2 million. but you refinanced your mortgage in 2020 to 3%. If you were to go trade, do a trade up type situation where you're going to go buy a slightly bigger, nicer house in a better community or whatever it is, you're going to sell your house now for $2 million, but the house that you want is now $3 million, right? And so not only what that does is, but you're also buying it at $3 million at 6% interest on your mortgage. And your property tax rate, which is at $1 million, is now at $3 million. So now you're going from $1,000 a month in property taxes to $3,000 a month in property taxes. And your mortgage payment is jumping up probably close to double. So it's preventing people from having this like knee-jerk reaction to just go, yeah, we're selling, we're taking advantage of this thing, and we're cashing out and we're going to buy our dream home. Well, that's not a lot of that's preventing people from listing their houses, which keeps that inventory low, which keeps, there's still people that want to own homes. So
that's an interesting angle, Matt, that I certainly have not discussed, nor had I really even thought about. So that's interesting, because there's a lot of talk about the fact that we're short supply. And I've had a hard time kind of like reconciling that when someone talks to me. Like, I'm thinking, why would there be tight supply? Although you just gave me the answer. So that actually poses an interesting challenge in real estate right now, because you have a divergence. It sounds like a large divergence. The interesting thing about real estate is that if you're going to live in the same area and you're going to live in the same lifestyle, it's not like you own something that you were the victor. Like, my house went up, John's next door, his is still crap. It's not like that. It's like, yeah, right, your house went up, everyone in your neighborhood went up. So, okay, great. Like, you went from 1 to 2, but so did everybody else. Yeah. So now to step it up, you have to go to 3. And now you're doing it at an inflated prices, and you're going to inflate your tax position, which these are things, Matt, I have to tell you, boom, I love it. I had not thought, I love it. I did not think of that at all. And so something interesting I want to ask you next is that, okay, so now I can see where this supply conversation has been coming from, because the way I had been viewing it up until now has been corporate ownership. I mean, so when I was in Encinitas, we were getting flyers consistently, right? From this investor wants to buy this investor. And now we look back and we know that was corporate ownership. What I was assuming was these corporations are able to take all this real estate onto the books through an unfair advantage, I might add. They get rates at nothing. They have cash flow through the roof. It's like one of my big beefs, Matt. I know you've heard me talk about it a lot, is that, yeah, a corporation's a corporation when it favors them. And then they're a person when that favors them. And right. It seems high. It seems very unjust.
We want to pay taxes. We're just people.
Right. Yeah. Well, yeah, exactly. Hey, listen, we want to give to this we want to donate some money to this campaign. I'm just a person. It's like, hey, it's tax time. They're like, whoa, I'm a corporation. Take it easy. Yeah. Oh, hey, look, your balance sheet's off. It looks like you're about to go bankrupt. Well, we're a corporation. We need some help here. The whole industry. So, oh, okay. Well, here's your cash. What are you going to do with bonuses? Well, we're people. We're getting the biggest bonuses in history, right? So, right. It's a funny thing that goes on with corporations in this country. It makes absolutely no sense, and I hope someone does something about it at some point. And I think it's really coming to the forefront. And the real estate market, I think, is a way that it's kind of pushing it to the forefront, because something I talk about, Matt, a lot on here is the fact that baby boomers, 80% of their wealth was derived from home ownership. A lot of people don't know that, like how important real estate is in this country, how important real estate ownership is in this country. So when you say that people can't afford to own, or young people aren't owning, and it's going to bring me to my next question with you, Matt. I read an article the other day, and it was ABC or NBC that I read the article. It was on my Apple News. We could look it up, but I know the ages. I know what they were saying. They basically said that the demographic for new home buyers is as old as it's ever been, meaning it's 38 years old. The new home buyers median age is 38 years old. And there was another caveat that made it, honestly, in my mind, even worse, which was their down payment was coming from inheritance primarily. So I said to myself, I know in the market, Matt, and I want to hear from you about real estate. In the stock market, the one concern that older market participants always have is, are the new market participants, the young people, are they participating? Because without them, you can't bid up stocks. Like nobody's bidding on stocks because you're in the situation you said, hey, great. Like I own Google, at $60, but so does my best friend. We bought it at the same time. So they're in no hurry to sell it back and forth to one another. You need someone new and excited and who hasn't been there to come in and start bidding the prices up. And when I saw that article, I thought that presents a problem, but a real problem, because now they put an age on it, 38. And they said, look, people don't even have the money for the down payment necessary right now. They're getting it from inheritance. What are you seeing out there, Matt? What would be like your response or thoughts? Just give me your thoughts on that.
I think what you're saying is makes sense to me, especially when you're talking about stocks. I think the difference that we have in real estate, and I do see that there's a lot of people that are, slightly older, I guess, than just a bunch of 25-year-olds coming in and buying $1 million homes, right? I think the difference is that we have a geographic component versus just a straight age. Like you can be anywhere and live anywhere and buy stocks, and there's not really, and especially with things like Robinhood and stuff like that now, where they've allowed you to buy fractional shares, and I'm not super familiar with that. I'll let you talk more on that, but there's less of a barrier to entry to the stock market, I guess.
Yeah.
But we also have geographic components where you have people that are just looking to move here because they want to move. They want to live in San Diego, or they want to live in a specific geographic location. But I do agree. I think that, you got to find the money somewhere, and not everybody's social media influencer, right? That's 25. And I know there's like this sentiment out there where people are talking about, oh, well, millennials, they don't want to own real estate because they don't believe in that. And they just they're more into this. I just want to have this lifestyle where I, live in my 400 square foot apartment and I take public transportation to work, and I want to travel all the time and spend all my money on goods. Right. Which I think it's silly to say that. They're doing that because of need and
necessity.
And barriers,
it's just
right. Like they don't have the option to go.
Right. I'm so glad someone else is saying it. Matt, I'm so glad someone else is saying it. Look, I'm a big believer that like we digest propaganda all day. And if anyone tries to tell me, I'm out there, so I meet young people that are looking to be successful and they're looking to do things. And like this thing, oh no, they want to live small and have nothing, right? They love meager and they want to travel the world. Listen, we all want to travel the world, but nobody wants to live like that. Like you go to Europe, like I guess and look, I shouldn't say this because I don't know, but a lot of people say that Europeans do live that lifestyle and they do enjoy it. I think I would need to talk to them like one-on-one, and then B, because I find that hard to believe. And then B, I would also go so far as to say, look, generationally over there, if that is the case, they've just been beaten down to a point that they don't believe it's possible, because that is not a pleasant way. So that's not people always like get on us Americans. You guys want everything. You want to live so big, right? Like your royalty does, like your duke and your like the people, they've earned nothing. They've done nothing. They were just born, and you give this to them and you pretend that they're the only ones that should have it. You're right. In this country, we think we should all have it, and you shouldn't be born into it, or maybe you can be born into it, but you should be able to accomplish it on your own. And so, Matt, I love that you said it, dude. I am so happy that you said that, because I think that's an important message, that it's not they don't want it, it's that they can't have it. And at a certain point, when you can't have something, you stop striving for it. Which brings me to my next point, Matt. Question for you. You've mentioned that prices are high and that rates are high. What do you see? So prices are high, rates are high, and the people that own homes are in a position where it really is not that intelligent to get out of the home, right? It's really not. It doesn't make a whole heck of a lot of sense. What do you see the remedy to this situation? Like what happens so that we can get, or do you think it's important that that demographic gets back in? So how do we get the demographic of 25-year-olds that just work and make money for a living back in the market? And what do you see? Is there something that needs to happen within the interest rate market, the real estate market? What do you see as a remedy to that?
Yeah, that's a great question. I think I think if I actually had the answer, I I would be doing different things after we got off of this podcast. But uh, so I don't really know the answer to that question, unfortunately. I think
You have an
interest
opinion?
rates
Just, I
coming
mean,
down is something that is likely to happen. I think if you talk to people that are analyzing that, they're saying, people that I watch are saying that after or middle of Q1 that mortgage interest rates should come down. I know the Fed just met last week. We had a presidential election, which there was a lot of, whether you say there was a lot of uncertainty, regardless of what side you were on, right? There was uncertainty in the outcome was going to be. The Fed met, they dropped interest rates in a quarter basis point. That followed up with the prior month of a half basis point. They're forecasting another quarter point either next month or January. It hasn't really affected actual interest rates, like mortgage interest rates yet. There was a kind of a little downtick back in September, but they've kind of jumped back up.
well, Matt, I don't know if you know, but those rate cuts, the initial rate cut, the 0.5%, that initial rate cut, it did absolutely nothing. I mean, the 10-year note ticked down, but then it went to all-time highs. Now,
Yeah.
that quarter point cut you're talking about last week, we'll have to see what happens. But a lot of people are, look, this conversation about rates, it really goes back and forth, because you have some people saying, hey, wait, it'll settle in. Then you have other people saying, look, they push too much currency. They're not going to be able to get rates down, right? Like, this is not going to work.
Well, and the Fed rate cut, I think people hear that and they don't really know what that means, right? They think, oh, Fed just dropped rates a quarter point, so instead of 6.5, it's 6.25 for interest rates. It's like, that's not how it works. That's that rate cut is the overnight lending rate the banks lend to banks and other institutions, right? So it's not a direct representative. The mortgage interest rates are tied, as you just mentioned, to the 10-year note. So it's
how
not a
long,
direct
Matt, does that
one.
traditionally take? How long does it traditionally take if the Fed's cutting rates? What does it usually take before it'll start hitting mortgages? Do you know? Before it hits mortgage rates?
I mean, usually that stuff's already baked in, right? Like they know that it's coming. So the market's already done all their adjustments that they're going to do. And people, as soon as they hear, okay, Powell said that they're going to drop rates a 0.5 point. Okay, well, people start planning on that now. Then when it happens, and everybody else is like, oh, they just dropped the rates, so we're going to do X, Y, and Z. They've already done the thing, right? They've already pushed all the buttons and pulled all the levers. And I know you talk about this a lot, where it's like you gotta watch what's actually happening, not just the news. As soon as you hear the news, it's already too late. You've already lost.
Right.
So you
that's
can't react
interesting.
to news. You got to be able to forecast it.
You have to be able to forecast it. I mean, I talk about that a lot. Well, you know that, Matt. I mean, I'm constantly harping on that. This is a forecasting tool. These are forecasting tools. If you don't know how to use the tools, if you're just waiting for news to come out and you think that that's having a real effect, you just don't know any better, right? Events, like even an election, it's a risk event. But the fact of the matter is the market was in an uptrend when that risk event was approaching. When you have a risk event, traditionally you'll have the gamblers come in that day and slice and dice and do what they do, and then you just return to trend. So to circle the wagons back, though, Matt, I was asking, what you saw as a remedy, and of course you're like, I wish I knew. But let's interest rates. So interest rates may come down. That could be helpful. What do you see happening, or the potential to happen, to get it back to where a 25-year-old EMT, police officer, whoever, some guy that's not a social media influencer, which is the funniest thing ever, because I don't think there's nearly as many as people pretend. I think most of it's completely fake. They're in their parents' basement living, calling themselves an influencer. I really, truly believe that. I've never met one, aside from one really sad situation, which I don't want to discuss right now, but he had a McLaren. He got canceled. And this is true. I was coming out of work in Carmel Valley, and he took his McLaren the wrong way up the road. This is back in 2018, and He killed like 5 people. I got there before police or anybody was there, Matt. And it was just flames, and it looked like tiny little blocks of metal. You couldn't tell there was a car. So that influencer, but he's not with us anymore, Matt. He is not here anymore. Matt, you have to be able to laugh at this stuff. So anyway,
that's one down off the 5 list, so there's 4 left.
That's right. That's right. So we have 4 left, and I don't think that all of those 4 are going to be able to carry this whole market. So what do you see? Like, what could bring the 25-year-old, like, normal human being back into the market?
I mean, they're just gonna. It's gonna have to be a geographic thing, right? Like, if you want to, especially for San Diego, right? If you want to be here, then you got to move to one of the outlying suburbs that you can actually afford. Otherwise, you just got to wait until, grandma and grandpa pass, or mom and dad pass, or whatever it is. Like, I think that's going to be the next way for people to get in. Because I don't think, in markets like this where they're so high, I think the median home price in San Diego County is like upwards of $800,000 at this point.
Yeah.
You're going to need $160,000 down minimum. You're going to
need that right? Minimum, Matt?
Would need one. I mean, there's some, I guess you could still get FHA financing on an $800,000 home, but the reality is, buy a condos still for $400,000 to $600,000. So there's still houses, but it's not, you're not getting, there's still stuff available. I imagine people are going to need help, right? Like, they're going to need some sort of help from a parent, or from,
it's interesting,
or multiple people going in on the same property. Like, but I don't see prices generally coming down. And the reason I still think it's better for you to do whatever you can to try to buy something, because rental rates, right? And I know you've talked about rental rates. In fact, I think I saw something that you posted yesterday with regard to, historical rental rates and the price to buy a home. It's like, it's crazy. Or it was incomes, right? Median income
median income to rental cost. And so, Matt, and that's an interesting point that I wanted to ask you about as well, because I know you're out there and you deal in rentals too. You've helped me before. You're helping me now. When rental right now, so I do know somebody that was in LA that said that, and he's like, he owns a lot of commercial buildings, but they're apartments, right? And he said for the first time he had to stop dropping his rent a bit to have 100% occupancy, or like whatever I forget what his number is, 92% occupancy. He likes occupancy rates super, super high. And so to keep it there, he had to drop a little bit. Are you seeing anything going on with rent? Are you like dropping, right? Yeah, you are?
Yeah, absolutely. There's a huge softening of the market, and I'm not necessarily sure exactly why, because I know, specifically for us, we've got a housing shortage as far as supply of available housing for people. I know that the city of San Diego is making a big push to allow for infill development to increase that housing availability.
Okay.
But over the last 6 months or so, maybe less, 4 months, there's definitely been a softening in the rental market. But if you have to drop your price, 100, 200, 300, 400, 500 a month, it's better to do that rather than to miss 2 months of $4,000 rent, right?
Agreed. I mean,
So and like, to your buddy's point, occupancy rate is the biggest thing. You don't want vacancies. That's the hugest negative to rental property is vacancy. So whether you're getting a little bit less in monthly rent is way better than getting zero.
I completely agree. So Matt, what do you think? I always talk about, and the way I try to explain stock markets and all markets is really through just that principle of supply and demand. That's really where I try to keep everyone focused, supply and demand. So let me ask you, what do you think keeps supply and demand from meeting? So what I mean by that, I appreciate the fact, it's funny that you were already recognizing that inheritance might be the next big move. I just read that article saying that that's going on right now, or it's just beginning, or whatever the case is. But boy, that's some bad news for those that aren't going to inherit anything, right? People like me
Yeah,
that are
and
never
I
going
mean,
to inherit a thing.
it's a really less than pleasant way to live, right? If you're just sitting there waiting for your parents or your grandparents to die,
Oh,
like, come on, that's not good.
yeah, you don't
That's
want
not
that.
good for
I know.
anybody.
Can you imagine that, like, all of a sudden, Matt, all over the country, when grandma and grandpa die, now you throw a party in your new house. You're thanks, Pappy. Thanks, Gammy.
And I'm
We're
sure they'd be happy, but
homeowners. We're
I'm sure they'd be happy
homeowners.
for you, but you don't want, I mean, that's
I
not an
mean,
enjoyable way to live. Like, oh, we're just going to keep renting until somebody dies.
right. I know. It's terrible. So the softening of the rental market, I guess, I would have an opinion that probably it is just that affordability issue. So if prices are high and rates are high, then your monthly cost is high. And so I think, and I've seen this definitely in some baby boomer communities, and I see it here. I live on a golf course right now outside of where I am, outside of Palm Springs, and I can tell you that they're delusional about what people are making out there. I mean,
Yeah.
really, the people that live here, they're not everybody's trying to gang up on them, which I don't know why. Their lives taught them to do things a certain way, just like our lives taught us to do things a certain way. And they're just continuing on with that trend. They have been taught since the early 80s to buy a house, sell a house, make some money, buy a house, sell a house, make some money. Same thing with stocks. So they just have continued to do that. But I can tell you that they're under this delusion that everybody's making 300 grand a year. I can't
Right.
tell you how many I talk to that they really believe that. They think that, well, I don't understand the problem. You guys are all making $250,000 a year. I tell them, I say, I don't know who you're talking to or why you think that. I assure you that is not the case. If you're making six figures, that is still a very good income right now. And they can't, their brain doesn't digest that because the way their lives work, and that chart that I put up yesterday that you saw, Matt, kind of speaks to it. That for the longest time, as rental went up, so did your income. And
Right.
then there was like a split, and then that split gets like insane, like it's like insane
Right.
at this point, right? So I think they don't know any better. So if affordability is probably why rent would come down, I can't think of another reason, Matt. But if you know of one, I'd love to hear it. Then, Matt, what would stop the real estate market, the residential market, from having to drop its prices to meet possible demand? Like, why? What would be the barrier to that happening? Or do you think that will happen? I know you're mentioning you don't think it will, maybe regionally or in certain pockets of the market, but overall, do you think that's the solution, or do you not? I mean, I'd love. I know everybody watching would love to hear your thoughts on that.
I'm not sure I have the answer. I unfortunately, I'd love to give it to them. But yeah, I think, I mean, it depends on what your needs are as a homeowner or owner of rental property, right? If you have a vacant unit, like we were just talking about, is like, if you have a vacant unit, you got to keep dropping the price until you get somebody, because, even at $3,000 a month, it's, that starts to add up. 2 months, 3 months, that's close to 10 grand, right?
Yeah. I mean,
That you lost, and you probably have some sort of mortgage on that. So you're losing twofold. So I think you almost gotta do whatever it takes. Is if you've been off the market or on the market for 2-3 months and you have vacancy, then I think you gotta drop it to whatever you need to do to get somebody in there.
okay. And then, so that's rental. So what about the buyer's market? What about that?
I mean, I don't know that I'm seeing. I think you do see price drops now,
Yeah. I mean, I
whereas
definitely,
prior to you didn't, right? Like
no,
2 years ago, you weren't seeing any price drops. It was
a
like,
couple
how
months
much
back,
over asking price are you going to give me, right?
that's what it
And that's
was.
what you're expecting as a seller.
Right.
Now there's things that are sitting on the market, and it's product specific, it's area specific. I mean, if you have something that's super updated and turnkey, I can buy it day one. I can move right in and I don't have to do anything. That's
Yeah.
very desirable, because I think this time of, back in 2020, when we had the whole COVID thing and everybody was DIYing every fix and update to their houses that they had been putting off, and were willing to do that. Now we're going to go buy something that's a fixer and, do the work ourselves and move in afterwards. There's significantly less interest in doing that these days.
Right.
So things that are turnkey, good schools, good neighborhoods, maybe cul-de-sac, things of that nature, those things are still selling and selling
Okay.
in pretty quick time. Things that are, maybe it was a flip, maybe it needs work, things like that are starting to sit, and you're seeing price reductions.
You are seeing some. So you're
Yeah,
seeing that now, Matt. You're starting to see
yeah.
some price reductions. What would you say in terms of? So let me ask you this: like, just like just your thoughts. The number doesn't have to be specific. Where we were back in 2020 and 2021 before all this started, before the inflation started, before all of that. Do you think we have to get back to that point? And if so, what percentage are we away from that? So you said it dropped a little bit. What percentage has real estate dropped maybe in price, just roundabout? And do you think we have to get back to those levels back there before interest
I mean,
picks up or no?
we're probably about, in my market, we're 100% appreciation or increase in price from
Oh, from the
5-6 years ago.
okay,
Meaning places have doubled. Right,
right.
the
I
prices of
think
homes have doubled. In the last couple months, or last 8 months since this year, or even over the last like 12 months, has there been a reduction in values? Maybe fractionally, but probably not.
fractionally.
Yeah, I think it's probably within a plus or minus 3%. I don't think it's
Oh,
much more than that.
so that's no big
It
deal.
might
I
be,
would call that
flat.
nothing. Yeah,
Yeah,
I would call
it
it
might be
flat.
flat, but it hasn't come down. So I don't know that you can get back to that. You would have to have some sort of global economic collapse to go back to prices of 6 years ago. Now, could
Yeah,
they
because
go
that
down 20 or 30%? And what would it take to get there? I don't know. It's I think also some sort of economic event
event.
that caused massive panic in the market.
Okay, that's fair
But
enough.
because you're always going to have things like people lose their jobs, people get divorced, people die, right? Like those things always happen. So that's
Right.
just a constant in the market regardless of what's happening economically. um, and so, but in order for that to happen on a larger scale, like something big would have to happen, even for a 20 or 30% price reduction or value reduction.
It would have to be something big.
I mean, I
Perfect. Well,
I don't see anything else that would cause that. People have so much equity, and like I was saying, people that have bought, like, the last couple of years is different because they had higher interest rates, but people that bought prior to that are pretty comfortable. They're locked in, right?
yeah,
They
yeah,
are
yeah.
locked in at that 3% lower rate, and they're paying on a house that they spent half as much as it's worth at this point. So
Yeah.
if they have to hunker down and stay in the house for 5 years longer, 10 years longer than they wanted, they can wait out the market. And so that's why I don't think you'll have the same type of way. If I'm circling back to the cyclical nature of markets, I don't think we're going to see something like we saw in 2006 through 12 or whatever,
12 or
where the market just completely tanked. You lost 40% of value, like 50%, 60% in some areas. I don't think we're going to see that.
okay.
Obviously something could happen and I could be completely wrong.
Well,
But
that's kind of
it would
outside of
be,
yeah, that's outside of anybody. You can't make an assumption. I mean, you're going off of the way life typically operates. I mean, yeah, there could always be some sort of crazy event that, gosh, only who knows what that would do to a stock market, what that would do to anything. But
yeah.
yeah, barring an event, you just don't see it. Which I think, Matt, we're coming up on the 45 minutes, and I don't want to take up all of your time today. So let me throw up. So anybody out there, and Matt, correct me if I'm wrong, but you do real estate outside of simply San Diego, right? Like you kind of work and I know you're from Northern California. You work up there too?
Yeah, I've got a network and a team up there as well in the Bay Area.
Okay. So
I've
for
got
anybody out
fingers.
there that is looking for somebody in real estate, they want someone that'll be honest with them, that obviously is very knowledgeable and very helpful. And I trust Matt. I've known Matt for nearly 20 years at this point. Reach out to him. There's the QR code there. Matt, thank you so much for joining me today. I think maybe next week or the following week, Matt is doing some commercial work too, where he actually is doing a very, very noble thing in San Diego. with housing and trying to increase the supply of housing for you renters out there. And I think that would be a great thing to talk about in another episode, Matt. So maybe I can have you back if you would like to come.
That'd be great.
Awesome. Thank you so much, Matt. Have a great day. And to all of you out there, remember that every day above that ground is a great day. I'll see you soon.